Hello all, welcome to our corporate tax return filing series. In this episode of this series, we are going to talk more about some of the common misconceptions that we have with respect to corporate tax return filing. At the same time, we also will discuss about some of the red flags that FTA may look at to review to come for audit later on. And what are the important aspects around corporate taxes that we need to be careful about is what we will be discussing. So to discuss more about this, I have my partner CA Naveen Kabra. So we are going to discuss more about these two topics. Yeah, hello Naveen.
Hi Balram. Hello.
Yeah, so as we know, so corporate tax law is in place now, and most of the businesses are gearing up for submitting or filing their first tax returns. Some of them have already filed,
Yes.
but some businesses are still thinking what to do with respect to corporate taxes.
That is true. That is true.
So just to address those kind of businesses,
Yeah.
what are the some misconceptions which some businesses may be still thinking about, but which is not true as far as UAE corporate tax law is related to?
Right. Thank you, Balram. I think first and foremost is that if you are a free zone entity, you are automatically tax free. And no income will be taxed. This is one of the biggest misconception which we have seen after the advent of corporate tax in the UAE. Everyone in the free zone, they say, I am a free zone company, I don't have to pay any tax. What are you talking about?
Yeah.
That's not the case. We know it has been clearly spelled out in the free zone guide, in the tax regulations, and in all the other explanatory notes from the FTA that it is only the QFZP supposed after meeting certain conditions is only allowed to have a 0% tax, and that too on the qualifying income. So within that QFZP also you can have certain criterion or certain incomes which will be still taxed at 9%, and there are then certain qualifying income which will be taxed at 0%. We have already discussed that in our previous episodes, but this is one of the biggest misconception which all free zone entities have, and that's why my humble request to all the free zone companies to definitely look at this point and understand their tax requirements, their tax implications, and go and file the tax return as and when required and pay the relevant tax.
Right.
This is one of the biggest misconceptions which I have seen. So there are certain other conceptions. For example, if I meet conditions by default of 0% tax rate, no requirement of filing the tax return.
Correct, yeah.
So this is not at all true. Even if you are a QFZP, and let's say if you are only and only running or organizing or performing the qualifying activities, for example, so your profits would be 0% tax provided you are meeting all the conditions. However, filing the tax return and ensuring or demonstrating to the FTA in the relevant disclosure forms as well that you are meeting those conditions is a must for you to go and get the benefit of 0%.
Correct. What I also come across is that if some company, not in the free zone, but in the mainland, if they have losses,
Yes.
or if their revenue is less than 375,000 dirhams, so they understand or consider that they are not subject to corporate tax.
Correct.
That is also one of the biggest misconception that we see.
Yeah. Everyone has to file the tax return is what I think should be the mantra. As they say, all the businesses, whoever has got a business license, and all the individuals performing a business activity subject to the thresholds which has been mentioned by the FTA, you have to file your return. That is the common mantra which I think every business should understand.
Correct.
Right.
In case of small businesses also, if they are falling less than 3 million dirhams, as you can explain further. So
Yes. They always feel that there is no need for them to do anything. They are just they can be in a relaxed mode and not to file the return, which is not the case. You have to register. You have to file the return. Definitely, there is no choice about it. Not required to register or file the return if the company is in liquidation. This is another big area of gray area which we have come across. Obviously there was a little bit of silence from the authorities also, but gradually they clarified on this point that even if you are under liquidation and if you have not been fully liquidated, you need to still file the return and you can register even with even with an expired or expired license. You can register yourself and file the return, and then complete your procedures and then go for liquidations.
That's right.
So we have seen this nowadays by most of the free zone authorities and even the mainland authorities. They are asking you for the clearance on the corporate tax return or a deregistration certificate before they strike off the name from the register. So this is now this practice has started, though it is still time to catch up. But in my opinion, it is on the right track as far as the liquidation process is concerned. So I guess that is already happening. That they are asking the liquidator also to confirm that, make sure that this company was or this entity was registered or not registered, as the case may be. And if that is the case, go and register and then deregister and come back and liquidate.
Yeah,
so that process is happening.
That's one area. As auditors also,
Yes.
or the liquidators also, as you mentioned rightly, that they're expected to look at the applicability of corporate taxes for that company and make sure that the company is registered for corporate taxes even though you don't have business, even though you're making losses. If you are under liquidation, make sure that the company is registered for corporate tax. Make sure that the filing that is required, since we are in 2025, for that company, if 2024 filing was supposed to be filed, you advise the business owner that you are supposed to file this return. You file it, and then you go for liquidation process. And once the completion of the liquidation process is done, then you also deregister by filing the last city return.
Precisely.
So all these periodically they have to comply with, and as you rightly mentioned, it is the responsibility of the liquidator also.
Correct.
To make sure that they are registered, filing the returns as it is required.
Absolutely, absolutely. This is one of the very important area, and as I said, there was a little bit of lack of clarity on this. However, FTA brought at the right time the right clarification on this, and thereby ensuring that the companies under liquidation are also following these norms, and of course creating that that ecosystem to ensure that the compliance is there. One of the key area where misconception is there is, as we know, that for the disclosure requirements under the transfer pricing rules, there are certain thresholds which have been kept, as we were discussing earlier, about the 40 million, 4 million and 500,000 for the connected person. Now, there is a big misconception in the fraternity and also in the tax professional fraternity, that benchmarking requirements or arm's length principle requirements are only and only to be done when these thresholds are breached, which is absolutely not the case. These thresholds, let me again reiterate, are only relevant for Article 55 of the UAE Corporate Tax Law, which talks about the disclosure requirements and reporting requirements. The Article 34, Article 35 and Article 36, which are the three critical articles under the UAE Corporate Tax Law, which talks purely about arm's length principle and related party and connected person, has nothing to do with it. Right. It is applicable for each and every single related party transaction, irrespective of any threshold. Let me reiterate, irrespective of any threshold. Yeah. So arm's length principle has to be applied for every transaction. There is no respite on that. So this is one of the biggest misconception which I have come across, and sometimes it becomes very difficult to explain to the businesses and business owners that, look, the disclosure requirement could be different. Arm's length test has to be done, has to be followed. But I think gradually the industry is catching up. The businesses are understanding that no, this is a requirement, and I would like to stress on the auditors of the companies to really stress on this point to their clients and to their business owners that, look, if arm's length test has not been done on a particular related party or a connected person transaction, it is very difficult for them to justify the financials and to attest those financials. I think if that practice is adopted, then automatically business will start falling in place, and the transfer pricing requirements or rules will be definitely adhered to and followed.
Right.
So we are seeing that is happening, but I think still there is a way to there's a long way to catch up. So I guess auditors will play a very crucial role here.
Correct. And With in relation to this transfer pricing rules, if a business is falling under small business relief,
Yes.
so of course there is a relaxation given from the point of view of TP compliance, but at the same time, if you have a transaction with any related party,
Yeah.
you are providing service or you are selling the goods.
Yes.
If these transactions are not at arm's length, if those transactions were to be accounted at arm's length,
Exactly. You may breach
you
the
may,
SBR.
your revenue may exceed 3
Correct.
million dirhams.
Exactly the point.
Whereby you are not even eligible for small business relief.
Precisely the point.
Right.
Precisely.
So to some extent, payments to connected persons can be considered as not relevant to consider or go for benchmarking and compliance with 3TP. But if you have revenue which you are doing a business with your related party, and then whereby you're not complying with benchmarking requirements, you may have an issue
Yeah.
if you don't do it.
Yeah. Yeah.
So even if you are falling in SBR, but if you have business coming from your related parties, you need to make sure that those transactions are at arm's length, and then you decide whether you are falling in SBR or not.
Yes, I mean, yes, but I think it's, I think on the connected person side also, Balram, it's a little subjective. So I wouldn't want to give that leeway to the FTA that tomorrow they come and pounce on you. Okay, even if you're a SBR, even if you're a small company, at the end of the day, yes, I agree that on the expense side, it could be less harmful because as it is, you are not supposed to pay tax. That's correct. There is no doubt about it. But from a consistency point of view, from a long-term objective point of view, these can be the questions, which FTA can raise. So I guess a connected person analysis is also important, though it may not require a very hard-coded benchmarking process, as we know we have to do for RP transactions, related party transactions. But still, an analysis is required. This is what I would say.
Yeah. As part of this misconceptions,
Yes.
see, as we know, the corporate tax law is applicable for the first financial periods of financial years beginning on or after 1st June 2023.
Correct.
So, can I or is it fine to go back to my previous years and make certain corrections to my my financial statements in order to move some of my revenues off CT regime period or bring expenses from previous years to CT regime period financial years in order to do some kind of adjustments to my taxable income and profits?
Yeah. See, I think FTA envisaged this, to be honest, that this may be the case. I think a similar situation they had envisaged when VAT regulations also came in, and there were very strict transitional provisions which were mentioned in the VAT regulations. Similarly, there are specific transitional provisions which have been mentioned in the corporate tax regulation. In addition to that, as you know, that there is a clause of general anti-abuse rules, which is GAR. So the GAR principle would apply in case if the FTA finds out that such adjustments have led to a revenue leakage or a tax evasion scenario. Now, let's say if there was an expenditure which is related to the current year, which is the year 23 onwards, and you want to go and book it previously, perhaps the FTA may not be really worried about it. I'm just telling you, though it is not advisable at all, because it also opens a lot of questions from various other stakeholders, including the auditors, and it also creates a scenario of a very weak corporate governance in any organization. Be it a small organization or be it a large organization, and it also opens the doors for employees to start flouting with the regulations and procedures in your company. So I wouldn't advise that, to be honest, at all.
The answer is clear, no.
Absolutely no.
Yeah.
But I'm saying what happens is the GAR hits in.
Correct.
So that is where a taxpayer should be absolutely not thinking about going that route, and should clearly just stick to the relevant principles. Yes, there is a possibility of errors. And we have under IFRS also, we have, if there are errors done, then you go and restate your financials and you make those financials correct. However, if you want to do that, you can do that, but GAR still may apply.
Yeah. So the intention is not to avoid the taxes, but there is a commercial reason behind
Commercial reason,
this,
no problem. Yes.
behind this, and as you mentioned, if there are any errors,
Correct.
or if there are any changes in accounting policies which expects you to
True.
apply that change
Yes.
retrospectively, so in those scenarios only you may go for that.
Precisely.
Otherwise, the answer is-
Deliberately we should not be, and which will lead to any tax leakages on the FTS side. I guess that will become a difficult
situation.
situation.
Of course, yeah. So yeah, going on with the kind of red flags that we can see.
Yeah.
We have discussed about misconceptions, but yeah,
True. So, Balram, about the red flags, let me ask this question to you. What are the most common red flags and audit triggers which you think the FTA may look at?
yeah. See, I think it is very early stage to talk about all this. Now we are only filing our first tax returns. We have not even completed this first cycle.
Yes.
Okay. But at the same time, one can definitely try to understand what kind of situations or scenarios could attract the attention of FTA,
Yes.
right? In order to consider for review of the filings that you have done, or consider for auditing later on to come and then audit your documents. So, but yeah, one should definitely look at the case and then decide accordingly. But most commonly, or what we can foresee, the common scenarios are like if you have inconsistencies in your reporting.
Yes.
As I mentioned, you have VAT returns that you file on regular basis. You have excise returns that you file on regular basis. You have custom documentation, custom records that generally are recorded in customs records or books. You also have the other local compliances like municipality and other tourism department and all those,
Yes.
wherever you report your business related transactions and then pay certain taxes. If you have inconsistencies among those records or numbers, among them or versus your corporate tax returns that you filed, right? So then it is a very obvious scenario that FTA may be interested in looking at why there are differences or inconsistencies in these reports or
Precisely.
in these numbers that you reported.
Yeah.
It is very easy. The government authorities can have the data reconciled and see in which businesses you have that inconsistencies. That is one easy way to identify the businesses to look into and then review. And second thing is that you may have high amount of revenue or high amount of business, but the taxable income or the tax that you pay is zero or very less.
So as compared to the peers, as compared to the industry.
Correct. So in the industry, you may have different scenarios, but your business is not following or falling into
Yes.
that brackets.
Yeah, I'm sure this is
That
one of
also
the
is a easy
easy pick for the
easy pick for the FTA to come and then
true.
conduct the audit for. At the same time, in the CT returns that you file, there are various fields, various information that FTA is collecting.
Yes.
One of the field that you have is to report the number of employees that you have, which is called as full-time employees or FTE numbers.
Yeah.
So if you have high business volume and high business income, but whereas you have less number of employees, which is generally not practically possible to run such a huge business with so less number of
Yeah.
employees.
So the substance, basically, one of the condition of the substance.
Correct. So that also one of the red flag that we can look at.
True.
Substance is mandatory for free zone entities to get that 0% benefit, but you may not go for that, but still you have high income but less number of employees.
Correct.
Even in mainland or in free zone not qualifying for free zone person status, there also FTA may be interested in knowing what is happening in your business.
True.
You may have transactions with your related parties or connected persons which is large in volume. You may have payments to your connected person which is high.
Right.
Right, that also is one of the red flags that FTA may be interested in looking at it. Second thing is that your consistency or your history of your transactions with respect to your payments to connected persons. Earlier, you are not making the payments or so high payments to your connected persons, though your business remains the same size and same kind.
Yeah.
But now suddenly you have high amount of payments to connected persons or huge amount of your transactions with related parties, especially with your cross-border transactions or entities or related parties outside UAE jurisdiction. That also could be one of the red flags that FTA may be interested in knowing it.
So, madam, do you think? Sorry, I want to stop you there. It's a very important point just came into my mind. So, do you think that, let's say, if a taxpayer is filing their tax return for the year 24 now, do you think that if their year 23 books are not in order, or they are consistently different, or different from the year 24, do you think that that can be a big issue?
Absolutely, it can be a bigger issue. See, one is that you are expected to follow IFRS. For you, one is that when you want to submit a financial statement which is prepared as per IFRS, you are expected to report 2024 numbers as well as 2023 numbers.
The comparatives,
numbers.
yes.
If these comparative numbers are not as per IFRS, there itself we have a non-compliance. Number two, the IFRS or the financials that you prepare for 24, they are not coming as independent numbers. You have to have your previous year's numbers being maintained properly, being prepared by complying with IFRS, which become your opening numbers for your 2024, and your closing balances for 2024 will have impact of that opening balances, which means your balance sheet items are cumulative numbers.
Right.
Not just for the period, but as on date.
Of course, yes.
So your previous year numbers also should be in line with or by complying with IFRS prepared, whereby your 2024 numbers are coming out properly as per IFRS.
So do you mean to say that FTA, if tomorrow finds out something is funny in the year 24 or in the year 25, in order to have those comparatives, in order to have those consistent accounting practices, do you think that they can go 3-4 years behind and maybe look at your business transactions? Just to ensure that the year 24, which is exposed to corporate tax, or the year 25, which will be exposed to corporate tax, is at the right manner, or it's accounted in the right manner. Do you think so?
By default, they will not be interested in looking at that, or they may not be interested in looking at that. But since, as I mentioned, the reason being the opening balances or previous year balances will impact your closing balances for current year, the balances that you report in your corporate tax returns. By virtue of that, they'll be interested in making sure that at least your opening balances are right.
Absolutely.
You make sure that your opening balances are updated, are corrected if they are not prepared by following IFRS, or they are not prepared properly. Make sure that your opening balances are correct. If you are reporting comparatives, make sure that comparatives are correct and their opening balances are correct. You make necessary changes. You reset your numbers. Accordingly, you correct your balance sheet and profit and loss account for the period, and then going forward, you follow them.
True.
Right. And
What could be the other points? Yeah,
you may also have other issues like you are a qualifying prison person, but you are doing huge number of transactions of business with your mainland entities. That also could be one of the red flags for FTA to look into. And other thing is that you may be late in registrations, or you may be missing your deadlines for registrations or filing corporate tax returns.
So essentially, you should not be in the bad books.
Correct. That also these are the situations or scenarios which are not normal.
Yeah.
So all those will be red flags for FTA to look into your business and then ask for further information. Other thing is that as part of your corporate tax returns that you file, FTA is also asking wherever you are supposed to have audit or report as a mandatory requirement from corporate tax point of view.
Yes.
They ask you to give or attach the financial statements which are audited. They ask you to mention the name of the auditor.
Yes.
And another field is that once you have these details, they also ask you whether you have the audit report as a qualified or modified audit opinion or a non-modified opinion. So obviously, if you have financials, if you have audit report with a qualified or modified opinion,
Yes.
if you are reporting that, you are expected to report that, of course, then FTA is interested in knowing that
Why?
what is the kind of modification that you have and why do you have it.
True.
Is it really impacting my taxable income? Is it really impacting my tax amount?
Absolutely. This is very valid point.
So auditors are expected to report or have the right opinion to be included in the financial statements. Businesses are also expected to make sure that they have the financial statement prepared properly so that you are not getting into situations where your audit opinion is a modified opinion, whereby you get into these situations of red flags.
Yeah. No, I think this is very, very important because this also creates, as we were discussing earlier as well, this creates or rather puts a lot of onus and responsibility on the auditor so that they ensure that the right thing is being done. And for the business owners also, it's important that their accounts are proper. Otherwise, if the auditor qualifies it or if they issue a modified opinion, then naturally they are exposed to a lot of questions from the stakeholders, which is a good thing. Are there any record keeping requirements, Balram, for under the UAE Corporate Tax regulation?
Yes, absolutely. So the Article 56 of the law clearly mentions that the businesses are expected to maintain records and they are supposed to maintain them for minimum of period of 7 years from the end of the financial year.
Right.
So what
Which
kind
means
of records?
effectively 8 years.
Effectively 8 years including the financial year.
Yes.
Right. So the records can be maintained in hard physical form or can be in electronic forms also. As long as those electronic forms or electronic documents are non-editable and you're able to retrieve them as and when they are expected to be submitted. So, and in addition to that, what kind of documentation you are expected to maintain? As I mentioned, all the supporting documents that actually are supporting or providing evidence to your transactions.
Right.
All are expected to be maintained. Be it your invoices from your suppliers or invoices for your expenses, records relating to salaries and wages. If it is WPS requirement, WPS documents also be expected to maintain. Your invoices, your contracts with your customers and various other parties. The payments that you make with your connected persons, the remuneration that you pay, the basis for that remuneration, transactions with related parties, and the basis to demonstrate that they are at arm's length. So all this related documentation is something that you're for all the assets that you have.
Yeah.
For which you're claiming depreciation.
Yes.
Or maybe you're saying the amortization.
So the asset registers.
Yes, asset registers. Wherever you have elections, where you are expected to have the valuation reports, that documentation, and the ownership related documentation also is important to maintain.
Right.
Anything that affects your profit and loss account, balance sheet, your taxable income and tax computation, all the supporting documents and information is expected to be maintained as part of your record keeping.
And these documents can be maintained in the soft or they have to be always in the hard as well?
See, the recommended way to do is to maintain in hard, but FTA also is all right that you can maintain your books of accounts or your records, at least documents.
Yes, documents, yeah.
In electronic form, as I mentioned. But those electronic form documents should be in a way that they are not editable.
And they can be accessed any point in time.
They can be accessed anytime in any point in time. Right. And for the businesses which are predominantly having significant amount of inventory, stocks,
yes,
then you need to maintain the records related to that inventory. Make sure that they are regularly counted. Make sure that physical count is matching to your records that you have or recorded inventory. If you have strong asset base or significant asset base, for that asset also you need to maintain documents as well as make sure that they are physically also available. Your cash records, daily transactions related information, bank statements, loans and finance related documentation, invoices and other records related to other incomes, and all this related documentation related to your income, expenses, asset, liabilities should be there.
Absolutely. No. Thank you, Balram, for that. I think this is documentation, maintenance of documentation, and data record keeping in the right manner is very, very important, and it goes a long way to support any of the inquiries from FTA, any of the queries from FTA, and even to keep that history as well for longer period, so that there is a proper trail.
Yeah, one important element to look at is that with respect to language, are you expected to maintain your documents in Arabic
Yes.
or English is fine? The answer to it is that you can
English
maintain
is
in
okay,
either
yeah.
of it. English is okay, or you can have it in Arabic also. But if FT authority or FTR authorities are asking you to produce or provide the documents in Arabic,
Then you have to.
then you have to translate that officially,
Official
translate into Arabic language and submit those documents in Arabic language. But otherwise, you are free to maintain either in English or in Arabic.
Amazing. I think with this, we come to the end of this session. Thank you, Balram. Thank you for this.
Thank you, Naveen.